Welcome to our first module on financial accounting reports, understanding the balance sheet. Some important facts about the balance sheet we'll take a closer look at. The balance sheet is prepared for an economic or business entity. It's prepared for a specific point in time. For example, the balance sheet could be dated December 31st, 2011. It includes assets, liabilities, and equity. Equity consists of both contributed capital and retained earnings. Assets are always equal to liabilities plus equity, and the balance sheet is frequently referred to as the statement of financial position. Let's take a closer look at each of these facts in turn. First, the balance sheet is prepared for an economic entity. We see that Google, an economic entity, has something to say, and accounting, being the language of business, helps Google communicate through its balance sheet. So we have Google's balance sheet. We said that the balance sheet is prepared for a specific point in time, and here we have Google's balance sheet, and it has two comparative balance sheets, December 31st, 2009 and December 31st, 2010. The balance sheet lists the assets, liabilities, and equity. We see that assets are listed first. We also see liabilities and equity listed second. Our assets for December 31st, 2010 are $57,851, and our liabilities match that same number. So our assets are equal to our liabilities plus equity. So now let's try to understand what are assets. Assets are the resources of the business. Assets have two primary characteristics. First, they're owned or controlled by the business or economic entity, and they're probable future economic benefits. If something is owned or controlled by the business and is a probable future benefit, that meets the definition of an asset. Some examples of assets are cash, buildings, and inventory. Here we see an assembly line of automobiles with some people standing by. Are the people assets? Certainly the people will bring economic benefit to the business. However, they're not owned or controlled by the business, so the employees working for a company do not meet the definition of an asset. Next, what are liabilities? Liabilities are the creditor's claims on the assets. Liabilities have two main properties. First, they result from past transactions and their probable future economic sacrifices. A liability is something that we owe, something that we have to pay, or something that we have to do in the future. Examples of liabilities are loans from banks and obligations that we have on credit cards. We can also have liabilities because customers pay us in advance for services that we'll provide later, and we can also have liabilities resulting from payments that we owe our vendors. Next, we want to take a closer look at equity. Equity represents the owner's claims on the assets. Equity consists of two parts: contributed capital and retained earnings. Contributed capital plus retained earnings equals owner's equity. Contributed capital is a component of equity, and it is the amount that shareholders paid for stock purchased from the company. So the contributed capital is a piece of owner's equity, and the total is the amount that shareholders paid for stock purchased from a company. Next, we have retained earnings. Retained earnings is also a component of equity, and it represents the amount accumulated as a result of profitable operations. So the piece of owner's equity that represents the amount accumulated as a result of profitable operations is equal to retained earnings. If we take a look at retained earnings would have a beginning balance, our starting point for the accounting period. To that, we add net income. Net income we'll study in more detail, but for now, it represents the profitable operations in the business. Subtract dividends. Dividends are profits returned back to shareholders. So beginning retained earnings plus net income minus dividends is equal to our ending retained earnings balance. So as we said in the prior slide, retained earnings represents the profits that are not paid out in the form of dividends to shareholders. Now let's look at a few transactions and see how they affect the balance sheet. We borrow $10,000 from the bank. So we have our balance sheet equation, assets equal liabilities plus equity. If we borrow $10,000, that means we're receiving cash. Cash is an asset, so assets go up. If we're borrowing $10,000 from the bank, we have to repay it in the future, so that's an obligation to repay, which is a liability. So this transaction results in an increase in assets and an increase in liabilities. Our next transaction is to sell $10,000 in stock. Cash is being received because we're selling stock, so assets are going up. The owner's claim increases. When we sell shares of stock, that means the owners have an increased claim on the business, so equity is increasing. We pay $10,000 cash for equipment costing $25,000. The remaining $15,000 is due in 90 days. Here we have several things going on. We're paying cash. Cash is an asset, so our assets are going down. We're receiving equipment. Equipment is an asset because it has future economic benefit. So we have a different asset going up, but we owe $15,000 in the future. Since we have to pay $15,000 in 90 days, we have a liability or an account payable, so our liabilities are increasing. We've got one asset, equipment, increasing by $25,000, cash decreasing by $10,000, and our liability increasing by $15,000. Pay $10,000 on accounts payable. So we have cash being paid. Cash is an asset. It's going down. If we're paying $10,000 on accounts payable is a liability. It's something that we owe. If we're paying on accounts payable, that liability is decreasing, so our liability is also going down. So we have a decrease in assets and a decrease in liabilities. If we pay $1,000 in dividends to shareholders, we have cash being paid. Cash is an asset, so the asset is decreasing. Retained earnings is an equity account, so equity is decreasing. Remember, dividends decreases retained earnings. So let's review. The important facts about the balance sheet are that assets equal liabilities plus equity. The balance sheet will always stay in balance. The balance sheet is prepared for a specific point in time. In other words, it lists all the assets, the liabilities, and equity at that point in time. Assets are owned or controlled by the business and represent probable future economic benefits. Liabilities are obligations that result from past transactions that represent probable future economic sacrifices. Equity consists of two parts. The first part, contributed capital, which represents investments by owners, and retained earnings, which represents the net income less the dividends paid to the owners over the life of the business. Economic events change the balance sheet, but the balance sheet will always stay in balance. Now let's review. Our first question, an asset is only acquired with cash, something the company owns, only contributed by stockholders, or only acquired with debt. An asset can be acquired with cash, debt, or contributed by stockholders. So our best answer is B, something the company owns. We also know that an asset is required to provide future economic benefit. Our next question. A balance sheet includes the types and amounts of revenues and expenses of a business. We'll learn later that that's the income statement. Only information about what happened to retained earnings during a time period, we already know that's the statement of retained earnings. The types and amounts of assets, liabilities, and equity as of a specific date, that is in fact the balance sheet, and the cash inflows and outflows during the period. We'll learn later that that's the statement of cash flows. So the best answer is C. Finally, the financial statements that shows beginning retained earnings, net income, dividends, and ending retained earnings is the statement of retained earnings, as we just discussed. So in conclusion, why is the balance sheet cool? The balance sheet is cool because balance sheets are always in balance and accountants continue to rule the world.